At this precise moment, iRobot Corporation is trading at exactly 2.92 USD, taking a violent hammering to the downside, with a loss of 0.47, or approximately 13.87% in the red for today's session on December 4th. When you look at a screen and see a former market darling, a company that was once valued at over $100 a share and courted by Amazon for billions, trading for the price of a cup of coffee, the immediate, visceral reaction is to look away. The expectation with iRobot at 2.92 USD is that this is a carcass. The market sees the double-digit percentage drop today and assumes the final nail is being hammered into the coffin. The narrative is simple. The Amazon deal failed, the cash is gone, and the going concern warning is the death knell. Most investors on their Fidelity mobile apps see this chart and think, this is a bankruptcy play, pure and simple. The equity is a zero. That is the rational, safe expectation. It is the expectation of a company that has simply run out of road. But the reality of what is happening behind the scenes with the debt structure of iRobot creates a scenario that is far more complex and, frankly, far more Machiavellian than a simple liquidation. We are not just watching a company go broke. We are watching a loan-to-own hostile takeover in slow motion, orchestrated not by a Wall Street bank, but by the company's own supply chain. The 13.87% drop today isn't just panic selling. It is the market waking up to the fact that the company's manufacturing partner, PICEA, has effectively bought the keys to the kingdom, and the equity holders are now trapped in a high-stakes negotiation between a rock and a hard place. To understand why this price action is so violent today, we have to strip away the consumer brand image of iRobot and look at the distressed debt reality. The expectation is that iRobot is an independent company fighting for survival. The reality is that they are now a vassal state of their primary creditor. Recently, it was revealed that an entity related to Shenzhen PICEA Robotics, their main contract manufacturer, acquired iRobot's debt from Carlyle. This is the single most critical piece of information for anyone holding this stock in a Robinhood stock trading account. Usually, when a lender wants out, they sell the debt to a vulture fund. Here, the supplier bought the debt. Why? Because PICEA is owed over $160 million in unpaid manufacturing bills. By buying the senior secured debt, they have jumped to the front of the line. They now control the foreclosure process. They control the assets. This drop to 2.92 USD reflects the terrifying realization that PICEA doesn't necessarily need the stock price to go up to win. They can potentially take the intellectual property and the brand through a restructuring process, leaving common shareholders with crumbs. However, this creates a massive paradox and a potential volatility squeeze that savvy traders are watching. PICEA needs iRobot's distribution network. A Chinese manufacturer cannot easily sell into the U.S. market directly due to brand trust and geopolitical tensions. They need the Roomba nameplate. This means they have a vested interest in keeping the operating entity alive, even if it requires aggressive restructuring. The reality that might exceed the expectation of zero is a scenario where PICEA converts that massive debt pile into equity, effectively diluting current shareholders but saving the company from Chapter 7 liquidation. This would turn iRobot into a zombie subsidiary, yes, but one that survives. For a trader using interactive brokers platforms, this binary outcome, total wipeout versus debt for equity, creates the kind of massive intraday swings we are seeing today. Let's look closer at the trading volume driving this 13% decline. It is heavy, panic-induced volume. We are seeing long-time holders finally capitulating. These are the people who held on through the Amazon breakup fee, held on through the restructuring layoffs, and are now finally throwing in the towel because the debt takeover news is too complex and too scary. But who is on the other side of this trade? Who is buying at 2.92 USD? It is likely high-frequency algorithms and distressed asset specialists who are betting on the dead cat bounce or a technical squeeze. When a stock drops this fast, the short interest piles up. If iRobot announces any positive news regarding a forbearance agreement with PICEA, say a 90-day extension on their payments, the stock could rip 50% in a single session as shorts rush to cover. That is the treacherous game being played right now. It is not investing, it is survival combat in the order book. We need to contextualize how we got here, because the expectation versus reality dynamic is rooted in the failed Amazon acquisition. The expectation was that Amazon would buy iRobot for $1.7 billion, plug it into the Alexa ecosystem, and dominate the smart home. The reality was that European regulators killed the deal, leaving iRobot with a bloated cost structure designed for a growth phase that never happened. They were left with too many employees, too much inventory, and R&D projects that didn't pay off. This left them vulnerable to competitors like Roborock and Shark, who flooded the market with cheaper and, frankly, often better robots. The reality is that iRobot stopped being the innovator years ago. They became the incumbent, and in tech, the incumbent gets slaughtered if they don't pivot. The pivot never came because they were paralyzed waiting for the Amazon deal to close. Let's discuss the actual operations business, because amidst the financial engineering, they are still selling vacuum cleaners. The Q3 2025 earnings were, to put it mildly, a disaster. Revenue was down roughly 25% year over year. Cash and cash equivalents had dwindled to critical levels, around $25 million at the end of the quarter, which for a global hardware company is essentially empty pockets. They are burning cash every time they open the doors. The expectation is that consumers will always buy Roombas because it's the famous brand. The reality is that the consumer has moved on. The mid-tier market, $300 to $500 robots, is a bloodbath of competition. You can go on Amazon right now and find a robot with LiDAR mapping and a self-emptying dock for $300 from a competitor, while iRobot struggles to match those specs at that price point because their margin structure is broken. They are trying to sell a premium brand in a commoditized market. However, there is a hidden asset here that the bears might be ignoring: the data. iRobot devices have mapped millions of homes. They know the floor plan of your living room. They know where your furniture is. In the era of AI and spatial computing, this data is valuable. The expectation is that iRobot is a hardware company. The reality is that they are a spatial data company trapped in a hardware company's body. If, and it is a massive if, they can survive this liquidity crisis, that data layer could be licensed to big tech companies working on home robotics or augmented reality. PICEA knows this. They're not just buying a vacuum factory, they're buying the maps. This data angle is the only fundamental reason the stock isn't trading at 50 cents right now. I want to pause here and ask you a question, because brand loyalty is a huge factor in this story. Comment below, do you still own a Roomba, or have you switched to a competitor like Roborock or Shark? I'm genuinely curious if you think the iRobot brand name still commands a premium, or if it's just another piece of plastic to you. Continuing with the analysis, let's talk about the PICEA entity again. This is a Chinese company based in Shenzhen. The optics of a Chinese firm effectively seizing control of a prominent American consumer robotics company, one that has had defense contracts in the distant past, are complicated. There could be a CFIUS review if they try to convert that debt into full equity ownership. The expectation is that the market forces will decide the outcome. The reality is that politics might intervene. If the U.S. government decides that iRobot's mapping data is a national security concern, they could block a Chinese takeover. That would force iRobot into Chapter 11 bankruptcy immediately, as PICEA would likely pull their support. This geopolitical risk overlays another dimension of terror to the stock at $2.92 USD. Let's look at the technical chart for today again. The stock opened higher, near 3.12, and has faded aggressively to 2.92. This intraday fading is a sign of weak hands. Every time the stock tries to rally, trapped holders use the liquidity to exit. The 3.00 USD level was a key support. Now that it has broken, it becomes resistance. If you're looking for an entry on your SoFi investing app or trying to catch a falling knife with your Fidelity brokerage account, you need to see a stabilization above 2.80 USD. If 2.80 breaks, the next support is the all-time lows around 1.40 USD. The RSI is buried in oversold territory, which usually suggests a bounce is due. But in bankruptcy scenarios, technicals often get thrown out the window. A stock can stay oversold all the way to zero. We also need to discuss the restructuring costs. iRobot has been laying off staff aggressively. They cut nearly half their workforce over the last year. The expectation is that this makes them leaner and more profitable. The reality is that it cuts into the muscle. When you fire your